I oftentimes found myself hitting stop loss and then reversing without any reason or real reason why. Price would always come down and hit my stop loss and then reverse. I'm like, why are they looking to, like, they're literally targeting my stop loss on purpose. I would literally say that out loud, like they're trying to get me out and me only. It feels like that. And I'm sure that most of you out there have felt the same way. It's like they hit your stop loss to the T and then reverse trend or reverse and go in the opposite way. And they feel like they're just targeting you specifically. Well, in all reality, they are targeting you, and not you just specifically, a bunch of you doing the exact same thing. Because think about it, if everyone is doing the exact same thing, the big banks and institutions are going to catch up on that, know where that liquidity is, and go seek it out. They're going to go seek out that liquidity to then free up liquidity for themselves to then place their bulk orders and continue in the overall direction of trend, because they're trying to get the best price possible. So in a way, they are targeting you. That's why I always say when the majority of people are doing something, do the opposite, right? So that's the case here with smart money. The majority of people trade retail. The majority of people are placing stops below this low. Do the opposite. Don't place your stops below that low. Do something else. Wait for the liquidity to be run and then get in the market.
Folks, if you missed out on joining the Trading Nut Funded Cup, don't worry. With over 3,000 traders registered, my sponsors City Traders Imperium have decided to run another, but this time they've promised the prizes will be even bigger and better. Folks, if you want to register for this and show your skills as a trader, click on the link above or the link below the video or in the podcast description, then sign up for free before 15th of June 2022 and get 10% off any City Traders Imperium product just for entering the competition. Good luck, folks, and we'll see you in the cup.
Hello, ladies and gentlemen. Welcome to episode 5 of the Smart Money Concept series. As always, big shout out and thank you to Cam Hawkins from Trading Nut for making this all possible. I really hope you all are enjoying the content and the series that we have been creating for you over the past few weeks. And in this episode, I will be talking about the theme of institutionally sponsored candles. So pardon my drawing here. I'm not an artist whatsoever. However, I feel this is a great representation of explaining what a sponsored candle is, how to identify it, and how to trade it. So first and foremost, a sponsored candle or institutionally based sponsored candle, the same thing, is a push in one direction by the big banks and institutions. That's goal is to take liquidity from retail trader stop losses and to free up liquidity for themselves to place large orders. So you see these large movements that happen in the market following equal highs or equal lows, aka liquidity being taken. The reason why you see very strong moves is because, well, first of all, we have to understand who's moving the market. And now we all know it is not us, retail traders. It is not us. It is the big banks and institutions that are really pushing price. So we have to understand how they're doing so. And in order to understand that, we have to understand liquidity. Liquidity is huge. Freeing up liquidity, meaning placing these massive orders in the market, takes tons of liquidity to do so. And in order for them to be placing however many lots, standard lots they're placing, how many contracts, they have to free up enough liquidity to place those huge orders. So how do they do that? Well, first, they have to take liquidity. So if they take liquidity to the downside here, let's just say they take sell side liquidity, they're selling in here, okay? They're pushing price down. Retail traders are buying at support. Okay, so AKA equal lows. They're buying, placing their stop losses below the low. So when the banks sell down, right, retail traders are forced to buy back their positions, right? So if sell back their positions to the market. Because if they're buying up, placing their stop losses and price comes down, they have to then sell their positions and get out at that price because that's their stop loss. So what that creates is a lot of free liquidity. when you are forcing retail traders through hitting their stop losses to buy or sell back their positions, that means you take that liquidity. You are freeing that liquidity up for you to use, or for these big banks to use. So in order to place massive orders at this particular price, they have to take and free up liquidity in order to have or be able to place such a large contract at that price, or else they won't get filled, right? Because there's not enough liquidity. So they have to free it up, aka taking your stop losses. So, I think we all kind of started off as retail traders in some way when we first started trading, myself included. And I'm sure that you can relate to this mini story that I'm about to tell you. So when I was a retail trader to start about 5 years ago, I used to trade what everyone else traded: resistance, support, trend lines, etc., etc. I oftentimes found myself hitting stop loss and then reversing without any reason or real reason why. Price would always come down and hit my stop loss and then reverse. I'm like, why are they looking to, they're literally targeting my stop loss on purpose. I would literally say that out loud, like they're trying to get me out and me only. It feels like that. And I'm sure that most of you out there have felt the same way. It's like they hit your stop loss to the T and then reverse trend, or reverse and go in the opposite way. And they feel like they're just targeting you specifically. Well, in all reality, they are targeting you, and not you just specifically, a bunch of you doing the exact same thing. Because think about it, if everyone is doing the exact same thing, the big banks and institutions are going to catch up on that, know where that liquidity is, and go seek it out. They're going to go seek out that liquidity to then free up liquidity for themselves to then place their bulk orders and continue in the overall direction of trend, because they're trying to get the best price possible. So in a way, they are targeting you. That's why I always say, when the majority of people are doing something, do the opposite, right? So that's the case here with smart money. The majority of people trade retail. The majority of people are placing stops below this low. Do the opposite. Don't place your stops below that low. Do something else. Wait for the liquidity to be run and then get in the market. So here's a makeshift illustration as to really what I mean by how to identify a sponsored candle. And there are rules to a sponsored candle. Let me get into that first. The first rule is absolutely 100% it has to take liquidity. 100%, or it's not a sponsored candle. It has to take liquidity every time. In this situation, this sell to buy candle, this sell candle swept these equal lows. Okay? It must also, doesn't have to be an engulfing candle, but it has to close as an engulfing candle, meaning there should be little to no wick whatsoever. And you can see there's no wick here. There's no wick here. It's just straight engulfing. The next candle must be followed by a violent move in the opposite direction, or the correct direction of trend. So in this case, if we are pushing long, then the right candle should be placed, or should be created to engulf or come equal to the prior candle. So it should really fill the prior institutionally sponsored candle, or engulf it in its entirety and push higher than that. So let's first start off by talking about structure, because that is the most important thing. You want to be looking for these sponsorship candles in the opposite direction of trend, meaning if we are bullish, you want to be looking to take sell side liquidity, because you're looking for the sell to take liquidity and then the buy to continue with the overall trend, aka the bullish run that we're seeing. So higher high, higher low, higher high. Now we're in this pullback, higher low, and then the higher high is what we would assume, right? Continuing with overall trend. What you don't want to see is, you don't want to be in a bullish trend and see buy side liquidity taken and then a sell off, because you don't want to be pulling back to sell, because you're not in a bearish market. You're in a bullish market. Oftentimes when that happens, people are tricked, and it's just an overall pullback for a continuation. They place their entry at the mitigation candle, which I'll go over in a minute, and they lose because they're not trading with structure. So structure always trumps everything. So continuing, you will oftentimes see either some sort of demand level or another sponsorship candle that the sell to buy candle came into. Oftentimes, sponsorship candles come into a prior sponsorship candle or some sort of supplier demand level. In this case, since we're buying up, this would be a demand. You will oftentimes see liquidity being built up. And if you would know this if you watch my videos on Smart Money Concepts on my YouTube and through the Trading Nut YouTube, you will see and notice liquidity being built up prior to these levels being met, prior to a sponsorship candle being met, freeing up liquidity to then place their orders and mitigate at the previous mitigation candle, right? Because what has to happen, the reason why they have to come back down into this candle is because they have to get out of their orders. Because if they're selling, if they sell, right, to take some sort of liquidity, it could be in here, right, to take some sort of liquidity, and then they buy back up to the upside, well, they're still in these sells right here. They have to get out of their sells because if price just continued up, they're in drawdown on those sells. They need to mitigate those sells. Mitigation or mitigate, the word mitigate means to make less severe. And they're making this position, the sponsor candle, less severe by mitigating it, by breaking even on it. So they've come down to the same exact price in which they previously opened. So that means they're net zero in loss and profit. They're break even. They get out of those sells, and now they can continue with their buys without being in drawdown. That's why mitigations occur. So usually you will see liquidity being built up prior to a level, trading in the right direction trend. You will see an opposite, a sell to buy. In this case, since we're buying, if it was selling, we'd like to see a buy to sell. But a selling sponsorship candle coming into a level, it doesn't always have to come into a level. If it doesn't, if there's nothing pretty over here that says, oh, this is beautiful sponsorship or demand level, it's okay as long as you have a sell to buy candle in the sell candle is the opposite direction of trend, the buy candle is the right direction, that sweeps liquidity and breaks counter trend structure, which I'll go over in a minute. As long as you have that, then you're fine. But what gives us more conviction and more confluence is seeing that the sponsorship candle comes into a level of demand or a prior sponsorship candle to mitigate the orders. Okay, so once we have bought back up, right, let's just say that the counter trend structure is, let's just go right here, right, doing this, okay. Lower low, I know this is crazy, guys, but bear with me. Lower low, lower high, lower low, lower high. The liquidity is right here, okay. Lower low with this candle, sell to buy. Once price gets back above the most recent structure, the swing high here, right, comes back above there, we're a counter trend and higher trend, or higher time frame trend. So lower time frame trend and higher time frame trend bullish again. We have broken the counter trend structure. So that means higher time frame we're bullish, lower time frame we're bullish again because we have broken the most recent lower time frame swing high here. Okay, once that occurs, you would like to see a retracement into your sponsor candle to mitigate the orders right at the open, and usually place orders, or you can place your positions at the open of the sponsor candle or the 50% mean threshold of the sponsor candle. Either or both would work just fine, right? And then you would look to buy back up. Stops would go below the body closure of the sponsored candle move. All right, so hopefully that makes sense, and I have described it in a way that you understand. And if you don't understand, please watch more of the Trading Nut YouTube videos through Aerial Effects and the Aerial Effects YouTube videos. We also have courses that go way more in depth on this and how you can catch stuff like this every single day, because it happens every single day. That's how the markets move. And you can definitely DM us and ask us any questions you have. I'll be happy to help you. So now that you know the basics of how sponsorship candles work and liquidity, now let's go into a few examples, and I've written them down here on my phone so I don't forget. I'm going to first start off by talking about GBP Chef. Okay, so now it's not always, I will have you know, it's not always going to look as pretty as this. Okay, but it will look relatively similar in some fashion. It's not going to look as pretty, but the concepts are what we have to understand. You can see here that if I tell you where is the sponsorship candle here in this big picture, it's going to be hard to identify right off the bat. Because one, we don't know structure yet. I haven't told you about structure. And, it's not as pretty as this drawing, but the concepts are there. And as you know, through time and price, if you haven't watched the time and price video, I think a couple of videos ago, I think it's episode 3 maybe, please go watch that. It all ties together. You will notice that the sponsor candle moves happen at certain times of the day. I'm not going to go into that right now. Watch those videos so you have an understanding. So let's first start off in here with GBP Chef talking about structure. And I'm zoomed out quite a bit, so I know it's blurry. You don't see the candles. We'll zoom in a minute. Now, obviously, we know we're in a downtrend. We can just look higher time frame. We are bearish here in this direction. Okay? So we should be ultimately looking for lower lows and lower highs to occur. Well, having that understanding, we can see our lower low, our lower high, our lower low. Yes, we have technically closed above this most recent structure. But we're still bearish overall. I would really have liked to have seen a firm closure above it, right? A firm closure, and then the retracement to make it counter trend bullish again and to make a higher high. But this is more of just a liquidity run. We never really sustained above this high. We kind of just trickled in and trickled back down. So I was still looking for sells because we are still overall bearish, right? So we have come up into a level of supply here. This is a level of supply. We came up into that. Now, I was expecting in here a lower low to form because we sweep liquidity. We come into an area of supply. We're making lower lows, lower highs. We should be looking for a lower low now, okay? So now we didn't make that lower low. Now what? Well, higher high, higher low. Could we be looking for a higher high? That's a potential. However, we know we still are technically bearish, so we should still be looking for overall shorts in a lower low. So when price got back up into here, I'm not going to be just placing a trade right at this previous supply level, even though it did react, and I'll explain why. Because we still are overall bearish. Why would you want to be buying and look for buys when we're overall bearish? We don't want to be looking for sells here either. I know it's confusing, but just bear with me. Because of the fact that we didn't make the lower low first. We didn't make that lower low. We made a lower high right in here. So a higher high could have been expected further up into this supply level, but then short off, which is why it's important to look for reactions from this level. So this is part of what we teach in our course again is how to identify the difference between an actual break of structure, which would be this, right? Or just a continuation. Continuation, sure. How to identify that and what you need to do and how to trade it, because there's a difference between trading continuations, which you would just simply place limits. If we had a firm closure, then we could look to place limit orders down in here in the most previous demand level, or continuations, or reversals, excuse me. Reversals, which I just showed you in continuations, meaning this, you want to be looking for reactions from here because you don't know if it's going to make that higher high, right? Since we failed to make the lower low. So we look for reactions first. So we teach how to do that as well. Now, going into this level, now we need to be looking for our liquidity, our sponsor candles, any sort of reaction that could take place, followed by a break of structure, et cetera, in order for us to take a proper position. So now that we have come into supply, we have reacted from this level. We can see the reaction from the imbalance, which we talked about last week or 2 weeks ago on the last video. We see the imbalance in the supply level, the distribution that occurred, and the following subsequent down push. We pulled back up into it, and we've created liquidity prior to coming into this level. Where's the liquidity? It's right here. This descending liquidity, all these highs, we haven't pushed up into it. It's creating liquidity for this massive run to the upside and then the subsequent fall, right? So what happened was we pushed up into the level, we pushed back down. This is the structure, right? Counter trend, higher high, higher low, higher high. Really, this is just the higher low right in here. We never closed below this level. We can see we kept pushing back up, so we never sold it yet. Now we got another reaction, still a reaction within the blue box, and now we have closed below this level, right? We have come down and have taken that low out. So now we are counter trend bearish now and higher time frame trend bearish. So what do I mean by that? Higher time frame bearish is simply just what we were talking about. Lower low, lower high, lower low, lower high, lower low, just like that. Counter trend bearish now is a break in the lower time frame trend to the upside, back down. Counter trend bearish now. We can look to pull back and go short. So where is the liquidity? Well, we just identified that. Now, where is the sponsor candle? Well, we first have to go back to our rules. What is a sponsor candle? It takes liquidity. Okay, cool. Did this candle take liquidity? Yes, it did. It took this liquidity and this liquidity here. Did we break counter trend structure yet? No, we did not. What other candle took liquidity? This green candle took liquidity here. You can see the descending liquidity right in here. These highs, we snagged that liquidity coming into an area of interest, this blue box, right? And then we broke counter trend structure, closing below this level and this level here. So now we should be looking for pullbacks into the sponsor candle. So we simply can just place our order right at the open or the 50%, doesn't really matter. The 50% would not have been hit, but the open would have. Clean buy to sell candle. We can see little to no wick. We had a little bit of a wick, that's okay, but mostly body. And look, the next confluence, the engulfing of the sponsor candle. What time of day did this occur? 8 a.m. Eastern time, London, New York exchange, or transition, I guess I should say. 8 a.m. Eastern time, that's between London and New York. It's just the overlap period prior to New York open and the stock market open. Perfect time and price. Breaking counter trend. So now we want to pull back up into this level. Sponsored candle. What happened again? Liquidity being formed. What do I always say? They love to form liquidity prior to coming into a level of interest. They love to do it. So form the liquidity, buy to sell. Breaking counter trend structure again, closing below it. Now you say, well, this is a lot of body, not a lot of wick, or not a lot of body, a lot of wick. Well, yes, it is. So what is a wick? It's simply, in this case, buying and selling at the same time, just on a lower time frame. A wick to the downside is selling and buying at the same time, because it has to sell and then buy back up to close right there. Look at where we came into. The sponsor candle, creating liquidity prior to that, buying up into it to then sell off and break counter trend structure. Exactly what I had drawn up right here. We sold, taking liquidity into a prior sponsor candle. Now this becomes the sponsor candle. Now this becomes the sponsor candle. Okay? And look where we came into, where we reacted with the overall level. What price point? I'll just make this, I'm going to make this yellow. 1.26 psychological level, 1.26. You will oftentimes see price react and move away from these psychological levels, these round figures. These are where the big banks and institutions are looking to get in, looking to place their large orders. So they have to free up, again, the key term free up enough liquidity, take liquidity to then place their orders around those psych levels. So many confluences in here to take a trade, ladies and gentlemen. So many confluences. So we'll get rid of that. And now we can scale in to what's going on in here. So I'm going to do bar replay. I'm just going to go to the 1 hour. We want to find a candle that is mostly body and less wick, right? Because what's a wick? It's just buying and selling at the same time. So we keep going, 30-minute, 20-minute. Here we go. This is more body than candle, okay? So really where you would want to place your order is at the open. And now you're going to say, well, it already mitigated. Yeah, it did already mitigate. However, oftentimes it can come up and mitigate again after the lower low is formed. You want to see that lower low formed, right? So one, it formed here. You guys, you can say this is a closure. So the pullback into this most recent supply level would be valid, which it did and then fell. However, we oftentimes see the overall lower low in the market, right? The lower low, and then the overall pullback lower high into that sponsor candle, which that's exactly what happened. We came into the open of that level to the exact T. And you can see just the precision of these smart money plays, guys. It's so precise. Sometimes I don't even get into the trade because of the spread. That's how I'm so precise. I don't even get in because of the spread sometimes. So open of the candle, buy to sell, sweep liquidity, came into a prior sponsor candle on the higher time frame on the 3 hour. This is also an area of imbalance on the lower time frame, another confluence. What else do we have? And this is kind of just tying everything together through my prior videos. We have distribution. We have a slowdown in price. Distribution, we have the spring, we have the closure, and we have the test. This is the test right in here, okay? And then we have the continuation. So many confluences for a trade right in here, or right in here, right there. So that is GBP Swiss franc. I will now go over another pair, Euro USD. So this trade occurred, and this was sent to our VIP members, as are all these that I'm going over. This happened in 2020, and this is a perfect example. So we have to go all the way back to price to see what's going on in here. So I'm going to do bar replay again. I'm going to do this. Hopefully I can get down to the 1 hour. There we go. Perfect. We can see in here. Well, now sponsor candles, I know I say that they take liquidity. They do. They must take liquidity. But sometimes it's okay to sell based off of structure or buy based off of structure, in my opinion. If we're selling off lower low, lower high, lower low, lower high, lower low, lower high, and are just kind of trickling like this, normally you just come back up into the last buy to sell in this case, and you continue to short off. And we have actually caught so many different moves within this downtrend here within the VIP community during March of 2020. So this is right when COVID was coming out, actually. We had an entry here at the inefficiency, so our last buy to sell candle. We had another one at that inefficiency right there. We had another one when news came out. I believe this was at FOMC or NFP. I don't remember what day March 12th, 2020 was. But I know we placed another one right there, the sponsored candle right there. Lower time frame liquidity run, buy to sell engulfing to the downside. Lower low was formed overall, but we pulled back up into that level. And we actually had, I think there was like a 30-minute buy to sell right in here that price actually came into. So I think it was right at the start of the wick right there, and I think we mitigated right there too, sweeping this liquidity in here. So many different examples, and it doesn't always have to be pretty. It's just the concepts have to be there. Where's the direction of trend? Where are the sponsor candles? Where's the liquidity? Where's the imbalances? What time of day is this occurring? Okay, so again, this happened at the mitigation was created, or the imbalance was created at 3 in the morning, London session open. Mitigation occurred at 9 a.m. Eastern. This is prime New York session. This candle here, buy to sell, was created at 3 a.m. Eastern time, London session. The mitigation occurred at 8 a.m. New York session. This candle was created at 8 a.m. New York session, and the mitigation occurred at 5 o'clock London session. So time and price, so important. Do not overlook this stuff. There's so many different key facets of smart money, but being able to tie it together is what's going to make you unstoppable, I promise. So the next one I'm going to go over is Euro JPY. Now, this is April 30th of 2020, so I'm just going to go back. April 30th, I'm actually going to go to the 1 hour here and find it. April 30th of 2020, just bear with me, guys. I have to scroll all the way back. April 30th, right in here. Okay, perfect. Now, I am having a little trouble going back to 2020, or really the prior years, and going down to lower time frames with bar replay. I don't know if you guys are having the same issues. I have TradingView Pro. I've had Platinum or something before, the better one. But it still gave me the same issue. I would go to bar replay like a couple of years ago, and then go to a lower time frame. I'm guessing they just don't save all of that data way far back. So I guess I can't go down to the 15-minute time frame back in 2020, which I'm at here. So I'm going to talk about what happened in here on the hourly, because that's the lowest time frame I can go into. And if you can go to the 15-minute time frame during this April 30th, 2020, please go check it out. It's a beautiful, absolutely beautiful setup that occurred. Now, Structure, okay, we are overall bearish. This is a counter trend bullish move. It is. We did buy in here. I know I try to stay away from counter trend moves, but the fact that the concepts were so pretty here around the perfect time of day, we did take an intraday buy, and it's okay that you can buy counter trend or sell counter trend, whichever direction, right? So in this case, buying counter trend, you can do so as long as you're targeting a specific supply level that has not been mitigated yet. You're targeting liquidity of some sort. You're trading at the right time of day, and it's all the concepts and confluences are there to be met. And you're only trading intraday. You're not swing trading it. Why would I want to be buying here on a 5 or 15 minute time frame and targeting something way up here? That's stupid because the trend is short. We want to be looking for shorts. So what we did was there was a beautiful area of liquidity. We had this low here and all these relatively equal lows right in here. So these are relatively equal as well. We saw the liquidity run, sell to buy, right? We swept the liquidity. We engulfed, we broke the counter trend structure. We pulled back, but not enough because where's our area of interest? What candle swept liquidity? This candle here. I think there's a 15-minute candle that's better, but again, I can't go into it. We have the imbalance here on the 1 hour though. The imbalance we came into very nicely. What time did this happen? 7 a.m. New York time. Prime London, New York session changeover. Liquidity sweep, engulfing, little to no wick, violent move back in the opposite direction or correct direction, in this case for the intraday move. We pulled back, creating more liquidity. Again, this looks very pretty on the lower time frame. I just can't go to it. 15-minute time frame looks the best here. Equal lows formed. What time did the sell to buy occur? 2 in the morning. This is London session start. Okay, we created that higher high. In the wick, we know that they're selling and buying on a 15-minute time frame. It's a beautiful sell to buy candle. We mitigated, filled inefficiency, made that higher high. So now we want the higher low. We pulled back into the mitigation open. So the open of it, we actually did come into the 50% of it right here. But I think we only placed our trade at the entry, or excuse me, at the open and not the 50%. But nonetheless, we still came into the mitigation area. Go look at it the 15-minute if you can go back that far, please. It looks very pretty. And this happened during news. There was some sort of news event, I'm not quite sure. But again, news is just an excuse to push price in the overall direction it was always meant to go. So the overall direction is bearish. However, the news was an excuse to push price up to take all this descending liquidity and have an overall pullback to sell at a better price, right? To have that overall pullback. So that was the excuse there for news, because it was going to do it regardless if there was news or not. Maybe not so violently, but it would have gotten up to this price. So now we have entered there. We created that sell to buy, engulfing. We've created that higher high. Now, many people would say, well, what about this sell to buy? This is an engulfing candle, kind of, followed by an engulfing back to the upside, sell to buy that came into a region of mitigation here and here. Well, why not buy it right there? Well, why not? Because we're bearish. So once the big move is over, we start trickling back down. This is simply just a fib play. It's an overall pullback. 61.8 retracement. Beautiful. I love fibs. Don't use them that often, but they're good confluence as well. 61.8. Key zone. We just trampled right through it. That's why we didn't have a reaction. The only way I would ever look to buy this is if we swept this liquidity here with this sell, and then we engulfed here and broke counter trend structure coming into the level. Lower low, lower high, lower low, lower high. We had the lower low and the engulfing back to the upside. Higher high, I would look to pull back to mitigate to then go long. That's what I would look for. But because we're still bearish and we had no reaction, of course, this just overall just made that lower low. But we took a lot of profit in here. Oh, excuse me. It's burped. We took a lot of profit in here. I took a lot of profit right there. I took a lot of profit at the 61.8. I think it was 117.3, something like that. I remember this trade very vividly, actually. So this was the move, and those are the reasons behind it. The next one I want to go over with you all, and I believe it's the last one, happened most recently on Euro CAD. And this occurred on April 1st of this year. April 1st. right in here. And this is what I talked about a little bit, I think, within the inefficiency video. We could tell by structure that we're bearish. Lower low, lower high, lower low, lower high, lower low, lower high. We ended up making the lower low. Forget all this. This is just current markups. At the time, we didn't see any of this price action. We could only assume that this was the lower high, the lower low, and we would make a lower high. So that's the assumption, that structure, and that's actually exactly what happened. We made the lower low. So what happened in here? Where's the liquidity? Liquidity, equal highs. All this liquidity being built up. We had a strong buy to sell. It's not as pretty as my drawing from earlier, but the concepts are there, right? We're bearish. Lower low, lower high. Equal highs, buy to sell, continuation, make a lower low. Where do we pull back into? Sponsor candles, supply levels, imbalances. There's an imbalance between this wick and this wick. Imbalance fill, sponsor candle move, liquidity run. This is the last point of return, meaning this is the lower low, this is the lower high. Last point before we break structure. Of course, that's why we didn't. And we continued lower. So many confluences surrounding that. What time of day? 5 a.m. Eastern Standard Time, prime London session time, taking Asian session liquidity, right? Asian session liquidity and taking liquidity from the prior day. We pulled back up into it. We want to mark off the imbalance and the open of the sponsor candle move. So now we want to scale in to what's going on in here, because price is now floating in here because we're looking to take a trade, right? Let's just say that it's April 22nd. We're looking to take a trade here. Let's go into it. So we can go down all the way. I think I'm going to go down to the 5 minute. I think that's where it was. But anyways, we never saw the reaction from it. We didn't come up into that level yet. We pushed down, we pushed back up. We finally did. And we open price. Oftentimes price pushes up very close to a level of mitigation or sponsor candle before market closure on a Friday, right? Or maybe for some of you Saturday, because you may be in Australia or some other part of the world that sees market closure at that time. We didn't react from it. Well, we did, but we never broke counter trend structure. We pushed up a little bit higher. The stop loss, if I just scroll back out, should go above the sponsor candle. So we shouldn't trade above that level. So in here, we finally saw the reaction. We mitigated those orders. We even pushed up to the 50% because the 50% is just from the open to the close, which is just essentially right here. So pushed up a little bit higher than that, but 50% would have been good as well. And then we ended up breaking counter trend structure back to the downside, right? We created that lower low, higher high, higher low. This is the low that broke this high. So this is the low that made this high here, right? Higher high, the low that made this high compared to this high. Lower low was formed. You could have placed just a simple sell limit at that level. Why? Why didn't I place it before on that other example? I believe it was GBP Chef. Why didn't I? Because we are overall bearish here, and we are looking to short. The other example, I believe, just get out of bar replay. The other example, I believe, which is right in here, we are overall bearish and looking to short. However, in this current trade, or this current trend here, we swept this liquidity, and then but we didn't make a lower low. We made a lower high, or a higher high, higher low here, right? So we could have easily had that higher high, but that's why we wanted to wait for reactions first to confirm. But in this case, on Euro CAD, go back to it. Sorry, guys. In this case, we're overall bearish to begin with. We made the lower low, lower high, and then we made the lower low, like we did not do with GBP Chef. We made the higher low. In this case, we made the lower low. So now we can assume the lower high and then the lower low. So we can simply just place a limit right there. Perfect. Take it all the way down. You can look for at 1.34 right there. That's the psych level. I mean, you could easily just do this as well. -27, -61, something like that. But higher time frame, we are looking to come lower. But 1.34 is a good target. 1.35 is a good target. But ultimately 1.32 is the swing target because of this daily time frame area of demand here. Area of demand with the imbalance that we haven't come into. So that is the reasoning why we're looking to short off into that level. Now going back to the 1 hour. That's how we can confirm it. Now we can confirm it the counter trend way. Guys, in our VIP, we send these setups every single solitary day, just about. There's really not always something to trade, but since we look at basically all these pairs for you guys, we oftentimes see some sort of setup or piece of analysis that looks really good all the time, because it happens every day and every time frame. So even if you don't want to be placing your limit orders at our areas of interest that we mark up, because we would definitely, for sure, have this as a level of interest, 100%, just based off of all the confluences. But let's say you don't want to do that. How do I confirm the trade? Well, go down to the lower time frame. Right in here, we had the reaction. There was no clear liquidity that was taken, no clear, buy to sell, break of counter trend. So there's really nothing to confirm here yet. But when we finally broke the counter trend this way, it took a little bit, it kind of just trickled here and never really went fast. So, we made the higher high, higher low, higher high, higher low, higher high. We closed below this level. We made the lower low. Now we can pull back to short off for confirmation. The confirmation occurred in here when we broke the counter trend structure. Really, you could have confirmed it in here just because of, all the confluence that I were just going over, sponsored candle, time of day, all that good stuff. But if you really wanted to confirm it, if you're very conservative, you could simply just do this. Wait for the counter trend to break, lower low is formed. You want the lower high. We should not trade above this high now. And now we should make the lower low. Where should we pull back up into? You could simply, if you don't have a sponsored candle or inefficiency to play off of or any sort of supply, you can just go 61.7086, 61.8, perfect. Where else did that line up? It lined up with our intermediate level of supply and the imbalance that occurred after, I think, maybe the news in Europe at this time. You can see the imbalance, the wick here, straight selling offered, like we teach in that prior video on inefficiencies. I think it's Smart Money Concept Series episode 4 on Trading Nut. And then we pulled back, we filled the inefficiency, came into that level of supply. That could be your entry. Lines up with the 61.8, and it lines up with right in here. Where do we stop? 37.2. It's like level, round figure. Okay. All these confluences, guys. You just have to have the patience and the education in order to see these things and trade them precisely. And this can offer you great risk to rewards from here to here, right? From there to there, even if you take it down to 1.34, like we talked about with the negative 27 and everything, psych level, profit level, 1.34, right there is a 1 to 15. If you wanted to confirm it right there at the efficiency fill, you could place it right there, right? 46 pips. 1.34 again. That's a beautiful 1 to 6.8. But what if you were smarter and understood that, we've already lower time frame, are efficient in here. We've already filled imbalance on a lower time frame in here with this, very trickle-like state we're in. After the fact we've made this move, prior supply, we really shouldn't push higher than this. You could have taken a more risky position and put stop right above that high for maybe a 12 pip stop, and you would have had close to a 1 to 27 risk to reward. So just in these two, 15 and 27, what is that, 37, 42, right? If I'm not mistaken, 42% in 2 trades over the span of $34 is right there. 12 days. Let's call it 13 days. Almost 2 weeks. 42% in 2 weeks. I'll take that. So hopefully you guys learned something new, guys. If you have any questions, please feel free to message me personally on IG or our Telegram or our Discord. And we'll be happy to help you in any way possible, really. If you want to take your education further and really advance your trading and take your trading to a whole new level, we do offer mentorship that teaches you how to do this exactly how we do it step by step, along with step-by-step, in-depth, highly descriptive courses that you can take part in as well. So hope you guys have a great rest of your day. Hopefully you enjoyed this and have taken some value from it. Be sure to check out our live session next Wednesday. I believe that is May the 23rd, I want to say. Well, let me pull up my There it is. May 25th. Sorry, May 25th. Next Wednesday, we will be going live with Trading Nut at 8 a.m. Eastern Standard Time. Be sure to tune into that. We will be talking about sponsor candles on our lecture, and we will be going over some live trades that you can take advantage yourself as well. And towards the end, we will be doing another one of our giveaways. So stay tuned for that, and hopefully you answer the question correctly. If you're the first one, you will win the cash and be our winner for the week. So you never know. Education and maybe a little extra for a bonus. So hopefully you guys have a great rest of your day. We'll talk to you soon. Thank you guys so much. Cheers.